Good afternoon. Hope everyone had a great weekend. It's Monday, almost 4 o'clock Eastern time. Want to talk about a few things here. One is about how podcasts are bad for your health. Not this one, and certainly not dozens of other podcasts that I listen to. All the ones I've been on are fantastic podcasts, by the way. Those are great. That's one of the topics in the Lumida Ledger newsletter. I also want to talk about NVIDIA, CES, small cap rally that we're seeing. Uber, you're going to hear Uber talked a lot this week. We talked about it last week at this time. It's had a nice move. Pleased with that. That was the example from the buy from uh, or sell to optimism, buy from pessimist. That was the example. Uber there. There's a couple of headlines to work through also. So let's get right to it. So the funny thing about this podcast are bad for your health is I saw this post on TikTok. I'm going to play.
Times you make 10x your money, and then the final two times you make anywhere between 100 to 1,000 extra money.
Okay, sounds like Bitcoin.
Okay, so this is a loser trade. Okay, but I would be long CDS. So what am I buying? I am buying insurance. I'm buying insurance using credit default swaps. I'm buying what's called protection, that there is no default event in 2025. Again, I'm not going to tell you which companies or what maturities, but just the general idea for me is I would like a little bit of an insurance policy in 2025 so that the men and the women that we have voted in have the chance to do their work in peace. I think that there is a small chance of some volatility next year. I hope it doesn't happen. I hope that this trade, like I said, 92 times out of 100 loses money. I hope it loses money. But if it hits, it will be the best performing asset of 2025. It will be the equivalent of Ackman buying CDS right at the beginning of the COVID crisis.
How does one?
All right, so that's terrible advice. It's a terrible idea. It's funny because last week we started talking about how the Mag 7 overweight was a bunch of hot air and actually create an opportunity to go buy Mag 7 names, which have now substantially recovered almost the entire move, by the way. So that was a great opportunity. Thank you, Chamath, for that. That was great. And you have a lot of people on these podcasts that really don't know what they're talking about. So focusing your attention matters, and identifying the right expertise and matching it to the appropriate type of input that you need to make a decision. And so this one, buying CDS, is this terrible idea. Listen, we're going to get bank earnings this Friday. They will be strong. They were strong the quarter before that. They were strong straight out of the banking crisis. GDP is growing. The economy exceeded expectations last year. People started the year last year expecting a recession. Haven't had that. Let me show you Visa retail spend data. Right, so we have data that's been coming in now from the holiday season. Do you think it exceeded expectations? Do you think it matched? What do you think happened? It was strong. Total retail spend in stores grew at a rate of 4.1% versus 1.6% last year. So, the economy is strong. People, maybe it's seasonal affective disorder. Maybe it's like issues in their personal life. I don't know why, but people are reluctant to kind of accept that. We see it in earnings quarter after quarter. Earnings exceeded expectations this past quarter. So, I think what's confused people is that you went from a very strong economy, maybe growing at 6% nominal GDP, which is like 120 miles per hour, down to 4% nominal GDP, which is like 2019, which is normal. And maybe that shift, I mean, it's kind of amazing. You have record asset prices, you have record household wealth, you got record stock prices. The Fed had a hawkish cut because the economy is doing too well. That's temporarily bad news, short-term bad news, long-term good news, which we talked about as well, right? So Yeah, there's not going to be a banking crisis. No need to buy CDS on a bank. And the interesting thing about kind of Chamath's views is that he said like a month and a half ago, hey, here's data that shows if you want to show that you're in a recession without saying you're in a recession, you know, there's this kind of bearish tilt to a lot of that commentary. It helps the bull market continue. Actually, need two sides to make a market. So from that sense, I welcome it. It's great. Keep it coming. What you have to be worried about is when everyone's on the same side of the boat, right? So there's an interesting note that was in this newsletter from Sam Rowe from TKR. Let me share my screen. So this is Rick Reeder. Rick Reeder is a very sharp guy, CIO of BlackRock, manages a lot of money. And the point he makes here is that maybe the business cycle is over. He says, hey, I know it's a crazy statement. 70% of consumption is in the United States driven by services. The economy has only gone to recession twice in 75 years. That's not quite right. But when you have a service-oriented economy where people spend on healthcare, education, phone bill, cable, it's incredibly constant. Unless you have some systemic shock, this whole idea of hard landing, soft landing, I just don't think it lands. So that's the other side of it. I don't agree with that statement, by the way. The business cycle hasn't gone away. We'll come back to that. But this is just a sign of optimism, right? We are entering the period of optimism. We have entered the period of optimism, right? The vibe session was ending around October after election, definitely ended. And you see that in improving consumer confidence. And that's why retail sales went up, because people are relaxing. They have a brighter outlook. They're spending more. And businesses have clarity, are going to invest more. So we are in the age of optimism. And you're going to see a lot more of that Rick Reeder commentary. Like maybe we've slayed the business cycle, right? That's going too far. That's like Irving Fisher. Stock prices have achieved a permanently higher plateau. Business cycle hasn't ended because one day banks will start making bad lending decisions. One day private credit will have mistakes were made moment. One day tariffs may go too far. One day inflation will come back. One day we'll see dramatic disruption from AI, which could cause labor market dislocation. I don't know which of those things will happen, but those are the kinds of things that ensure you'll get a business cycle, right? Or consumer confidence retreats. That can cause a shift too, like you saw immediately after 9/11, right? So you get excess spending in a certain category that pulls back. When GPU spending drops, I would be worried then. Then certain themes are going to pull back. That would probably cause a pullback in the stock market. And then there's a negative effect on the wealth effect, right? So business cycle hasn't gone away, but we're certainly not in a recession. There's just no sign of this. I find it amazing that people keep talking about it. It's really kind of amazing. I mean, we're looking forward to this year. Valuations are, yes, they're in the top decile, but earnings growth can continue. There's no reason they wouldn't continue. And they'll be led both by Mag 7, which has operating leverage, and the 493. Let me see if I can share this data point with you. I circulated it in the Telegram group earlier today, but it shows the consensus analyst estimates of earnings by category. And it's a good way just to get a basic sense of what industry groups are going to grow next year. And what you see is there's generally broad-based growth. So what we've seen in the last 2 years is technology leading. We're going to see a broadening of that. That's very healthy. So I may have to post that in the comments below. Let me see if I can find this real quick. Here we go. Let's share my screen. these are the top-down EPS and consensus bottom-up EPS by category. So take a look at the EPS growth for 2025. You know, these are analyst estimates, by the way. So you got to take that with a grain of salt. Information technology, that's 21%. Think of that as Mag 7. That'll also, you know, software's in there. Financial, 7%. That could be underestimating, in my view. That's my non-consensus idea. Healthcare, 19%. Healthcare, 19%. These businesses are cheap right now, and they're quality businesses, and they're compounders in there. I think over the last month, since this United Health shooting, I think a lot of that bad news is priced in now. So I'm warming up to healthcare. You still got to pick your spots, but you can broaden out. You can broaden out a bit more, I believe. So like Cigna looks pretty interesting to me, but there are other ideas in healthcare also. Communication services is showing 13% growth. There's some interesting ideas in that category. We've talked about like AT&T in the past, for example. Consumer discretionary, 10%. Industrial, 16%. You know, we were poking around there this morning. Don't like Caterpillar, but there's some interesting ideas like maybe United Rentals. We don't own those names yet, by the way. We're still trying to see where we want to focus, but there's some interesting opportunities there. That category was expensive. It's getting cheaper now. Still not where I want it to be, but it's been getting cheaper from this from the last few weeks since the Fed hawkish cut. And then you've got materials. So if there's a global economic recovery, then materials might do well also. That's a broadening out. That's bullish, right? If you look at like the equal weight indices, I think they look pretty good. Actually, this question came up on healthcare. I think the answer is actually none of these. I think the answer is Cigna, by the way. So United Health is too expensive. Elevance is a wonderful, wonderful business, by the way. If you can buy it cheap, it's not a bad idea from a certain perspective. CVS, you know, we own CVS. Let me show you what we do with CVS. This is the power of active management, by the way. And maybe we're lucky here. I don't know. But I'll show you CVS. So we had owned this. CVS turned out to be the canary in the coal mine, actually. It was actually a preview of bad things to come for Medicare Advantage, as opposed to being a one-off turnaround story, which is what our initial take was. But so CVS, we got out right here at this level. We saw that it was approaching the 200-day moving average. And we said, yeah, why don't we sell it? Because we expect this is going to be cyclical. And then, yeah, that thing fell off just fell off. So I prefer Cigna in this category, actually, because they don't have Medicare Advantage exposure. They sold off that business. It's a quality business, and it's, you know, it's cheap. And they also do buybacks. So, but I think there are other things to do. And I don't want to make this about healthcare, by the way, but someone asked a question, so I figured let me respond to that. There are several good ideas in healthcare. We had Merck in our stocking stuffer list. But if you're looking for like a 12-month play, healthcare is a good idea. If you want to make money in 1 month, it's not necessarily a good idea. That's a trade-off between momentum and mean reversion, right? So let's keep going here. So, you know, our newsletter was titled "Podcasts Are Bad for Your Health," and we just gave an example of that. You know, you just get bad advice on things that you shouldn't be doing, and you know, the issue is this. This is the basic issue, and I think it's a really good lesson for investing, right? What people talk about is what's right in front of them. People focus on the drama. It's a basic human instinct. People like to gossip around the water cooler, right? They focus on what's right in front of them. And whatever's in front of them is what's getting priced into markets at that moment. So it's better to focus on the periphery where new information is coming in that's not yet priced in, right? So 2 weeks ago, there was this news article on page 3 of the Wall Street Journal, proverbially speaking, saying that Russia may get more energy sanctions. We talked about that here 2 weeks ago, by the way. And then energy stocks went up. Why? Because that wasn't part of the conversation, but more and more people talk about it. There's an information diffusion process that plays out, right? Now everyone's talking about Tesla, right? Or was, right? Had the nice Q4 seasonality, animal spirits, and we have the markets are, NASDAQ is green. Let's take a look at the winning moves in NASDAQ. MicroStrategy, semiconductors leading the way. Meta, another one of our picks. Independent power producers, another idea we like as well. And where's Tesla? It's not on the gainers list. Let's take a look. Yeah, it's down 50 bips, so it's just lagging. My sense here is that this is leaking to other categories, and software also is leaking to other categories. Here's IGV, the software category. And where's it leaking to? It's leaking to semiconductors. It's leaking to NVIDIA. Look at semiconductors. Just had a major gap up. I hate chasing gap up, especially on a Monday, by the way. There's NVIDIA up 3.5%. So yeah, the attention was focused on Tesla, and the periphery, hyperscalers are still investing in CapEx. So now that attention shifted because of the CES show today. So, you can anticipate a lot of this, right? You can anticipate the change in focus. We're going to have bank earnings coming up on Friday, and I anticipate they'll do well. So bank stocks probably will start rallying ahead of then. And you got to make sure you're pre-positioned, and we already are, right? So those are better long-term investing ideas, by the way. So what else? Let's get back to the newsletter. I want to call out a few other ideas here. Well, there's Uber. We wrote about this on Twitter before. Obviously, it's done well. So what Uber did is they announced buybacks. Stocks with good management teams that don't have excessive share-based compensation and can grow earnings, they find a way, right? So green is that entry point. This has been really beautiful. Still only 20 times forward earnings, not bad. But now people will talk about Uber. Now you're going to see in a bunch of podcasts. The time to get involved was before that happens, right? You've got to pre-position. So now some of the things I called out in the newsletter are these factors: momentum, growth, earnings yield. And I also pointed out there are changes in what I call the best and the rest theme. So last year in January, you had a major bid in what I call like the best businesses in the world. What are those? Things like S&P Global. They get the license fees from the S&P 500 index. It's a pure high margin business, one of the best businesses in the world, right? Costco, Walmart, FICO. Every mortgage gets a FICO score. Incredible business. They've got a moat. They're not going to go anywhere. Those are fantastic businesses. So we're seeing shifts in these names, right? So you can see FICO has had this breakdown there. Costco, which by the way is more expensive than NVIDIA, 4P of 50, had a bit of a issue there. And so, there's more caution around those categories. Walmart, which is cheaper than Costco, so it hasn't had as much damage, right? This is 4P of 35. It's held up better. There's another data point for you that valuation does matter, right? Institutions drive these names. So what about VRT? Let's take a look at this Vertiv Holdings hot data center idea. Well, that lifted today on the whole AI theme, right? But it had some weakness. And you got Hero, which we talked about in the spring of last year. So this has been weakening also, right? So the headline from all this is rotation, rotation, rotation. When you can see it, just give you some examples of that, right? And if I go to our AI tool, I'm going to share my screen with you here. I'll show you what I'm looking at. So the big headline for 24 on the economic side was no recession, exceeding expectations. And you finish Q4 with a Trump win, which juices animal spirits, right? We saw small business confidence surveys hit 3-year highs. Consumer sentiment is elevating. Retail sales trounced last year's spend. Okay. So animal spirits are on, and you can see that in the data here across every time frame. Now, what's misleading about this, by the way, how you interpret this chart is animal spirits really took off end of September through year end. They had been a laggard, actually in the red up till then, but their performance was so strong that if you look at across timeframes, it looks like that they've kind of always been doing well. But it's really a recent phenomena. You can see that here actually. Here's the animal spirits chart. So around mid-September, as the market started to get more clarity on the election outcome, you could see animal spirits rip, right? This is November 3rd. It's around the election. And here was the Fed. Fed was a little bit later after that. And animal spirits are getting quite frothy right here. This is a trend neutered kind of 2 standard deviation top and down way to look at animal spirits. And this other factor, volatility factor, this is getting overextended. By end of day today, this should be at the 2 standard deviation level. The growth factor has been pulling back, even as the market's been going up, actually. Momentum factor had sold off. This is why names like we own App, for example. App had a pullback because it's exposed to both momentum and growth factor pullback. But momentum set up potentially to recover soon. It's oversold. These names, highly shorted stocks, are overbought. I made a comment earlier today to watch out for these junky names in IWM, even junky biotech stocks, because that's not good when you see this happen, right? So there's a lot of nonsense rally that happened Friday and today, and those usually look to these sharp, quick, and furious rallies that last 1 or 2 days, and then they give back. I think you're going to see that. And then you have here earnings yield. This is the equivalent of like value. The entry points and value are very strong, like right around now. And here we are heading to bank earnings season. So it's a great setup for the banks. So, that's a tool that I use to kind of focus on the right categories and not chase what happened, try to stay ahead of the curve and own factors and themes that have good long-term earnings growth that can get in at a fair valuation that identify the leader, or maybe it's a set of leaders, right? So let's keep going on here. Share my screen again. Okay, we talked about the best and the rest giving back. Talk about NVIDIA. I think the market's still underestimating NVIDIA. But this is quite interesting. Have you guys seen this? This is the OpenAI versus Google. So OpenAI had their 12 days of OpenAI, kind of playing on the whole Christmas theme. And then Google dropped their quantum computing. They dropped Google Gemini to Flash, which is very powerful, in the middle of that, and took some of the limelight. And then OpenAI responded with this: use ChatGPT for every search. And then Google responded again. They have a new capability where you can do deep research with Google's AI. I'm going to have a podcast with Michael Perek. Michael has been on our show several times. He's a former Goldman Sachs internet analyst. We won't hold that against him. He's one of the best. He's brilliant. He writes about AI every day. He's on top of it. So we'll get his perspective on this. But Google has showed up and they brought a bazooka. So this AI tool has a much larger context window than GPT. We use AI internally. We're running into limitations. We have to feed the same document and cut it up in different pieces to get some kind of valuable output. And it's multimodal and it's cheap. They're offering it free to developers to test. So, Google can afford to do that. And by the way, Google loves to roll out products that are nominally in test mode. They're actually in production, right? Gmail was like a test product for a long time. Google Labs had all sorts of test features that remain there for years and years. So, if you're not a large cap tech company and you've got big capex bills to pay, it's hard to compete with Google. In fact, if there's a top in the market, one of the signals, not if there will be, the question is when, one of the signals would be like an OpenAI IPO, right? I mean, they need more capital to keep funding all this investment. They have no choice. So how do you do that? You raise capital. You raise at higher and higher prices to keep your prior investors happy. How long does that run for? I mean, they're generating revenue growth, but I mean, Google showed up with a lot of capability, and Meta is too. Meta has 400 million people active on their platform, and they're focused on agents, and so is Google. Google's also focused on agents. We haven't even talked about Mark Benioff and Salesforce. I think they're probably laggards, actually, despite all the amazing salesmanship of Mark Benioff. I mean, they just don't have the same technical chops, and were late to the party, right? So let's keep going here. So what else? I think so. The key idea in all that is like information diffusion, right? What's the pace of information? How is it flowing out? I do think social media has transformed investing in a profound way because of how information moves. I mean, I can see names that rally that shouldn't be before the fact that they're on Twitter, and that cuts both ways, right? We showed an example of a Hero, right? That became a Twitter stock, and then after the attention moved on, it died. Let me show you another example of that. So, do you all remember Ferrari race? So this was a hot Twitter stock last year, and then all the excitement has gone away. It's gone nowhere. In fact, it's been losing money, right? So it's gone nowhere in 11 months or so. So this cuts both ways. You really have to, be discerning when you're looking at something online. So what else? I think we covered a lot of ground. That was pretty quick. Any questions? Quantum stocks. I don't have a strong view on this. Look, there's a short and a longer view perspective on this. I think the longer run view is you're going to have established players like the Googles of the world take a leadership position here. And if any of these guys get traction, they get acquired, maybe by like NVIDIA, for example, or someone else. But if you look at the technology some of these quantum operators have delivered, right, the way they measure performance, they use the number of performant qubits, but they'll measure like they've achieved a level of 2 functioning qubits, and it looks like optics management more than substance at this point. And again, that takes a lot of money to continue to invest in. So I don't think they're long-term winners. It's not an investment; it's a trade. That's what it is. So I mean, I think if you go in with that point of view, that's better than going in and saying, "Hey, look, I can sit on this and wake up 1 year from now," because I think in several months or weeks or 3 days from now, they could be lower. It's very hard to assess that, right? It's very hard to assess that when that happens, but it's not an investment. Those are trades. Some of them can run longer than others. I saw one name last night that I actually thought was kind of cheap. I said, "Gee, maybe I should look at that." But remember the CRISPR stocks like Editas and CRISPR? Let's take a look at those. Those were once thought of as transformational technologies, right? What happened to those stocks? Let's take a look. And gene editing is transformational. That doesn't mean that it's a great investment. These guys don't make any money. Look at Editas. This is a Cathie Wood stock, by the way. It's been in a horrible bear market. Peak hype was 2020. Okay, market cap's 118 million. And if you're not making money, then eventually the market is gonna call you out. All right, they have revenue of 78 million, but they're spending 153 million in negative net income. What about CRISPR? So that's why these are animal spirit trades. They're not investments. CRISPR, same thing. And quantum computing, same thing. I mean, what's the path to commercialization for that look like? So Fannie and Freddie, I think that's done. Look, if everyone's talking about it and Bill Ackman wrote a post and 500,000 people saw it, then most the upside's behind, right? Why focus on that? I wouldn't focus there. I mean, I would disqualify my attention from focusing there. It doesn't mean it doesn't make money. By the way, I think there's a good chance that actually Fannie and Freddie could be privatized. But let's say this: there are reasonable odds. I don't know that 50% yet. What I'm hearing is that Trump is looking to get tax cuts and pass a new budget and do kind of everything in one reconciliation bill, so that they can get over the requirement to have 60 senators, which is required to overcome the filibuster. That's very ambitious. We'll see if that can happen. They might do it in two parts, apparently. So does privatization of Fannie and Freddie get in that? Probably not. That's not going to be the priority, right? So, I mean, I would focus more on finding good investment ideas. Probably the other reason I think Rick Reeder from BlackRock is wrong about, hey, maybe we'll never see a business cycle again, is that, the AI opportunity is very real, and you're going to see winners and losers, and they will be sharp winners that have a lion's share of benefit, and you're going to have a whole lot of losers, right? That's just the nature of capitalism. So even if you don't have an economic contraction, you can have an earnings growth contraction from certain parts of the market. So, I think this is the time where you've got to stay focused. The markets, even though they're top decile valuation, I think they'll do fine on earnings growth. But where will that earnings growth take place? We talked about the different industry groups that'll benefit. I think there's probably less infrastructure spend than people are anticipating. We don't see it in the earnings reports yet. There's all this talk about infrastructure spending. Like Steve Eisman's been talking about that. Well, where is it? Where is it in the earnings? It's not there yet. That's one question. Then the other question is, how do you position within those categories? So I think, you got to be on your toes the next 5 years, the next 10 years, right? There's a lot of evolution, right? OpenAI said that they see a path to AGI potentially in 12 months. So in April of this past year, Jensen said 5 years. I thought that made sense. By the way, if they want a path to AGI in 1 year, it probably means that they want to do an IPO in 1 year, or they need to raise money. That's really what that means. That's how I would read that. I don't think you can get AGI in 1 year, right? Someone's selling stock. This reminds me actually of a post I did briefly this morning about, who's the smart money in financial markets. The smart money in financial markets are private equity firms. Okay, it's not the VCs. So let me pull this up for you. The Wall Street firms, they are service providers to these private equity firms, right? They provide financing. They help identify opportunities for them to acquire different companies. And, private equity firms are very savvy. When Apollo and BlackRock and Blackstone went public, it was in 2007. They know how to top tick markets. Goldman went public, in the later end of the dot-com boom. They know what they're doing, right? So, private equity is where you want to focus. Listen to what the private equity guys are doing, right? So Byron Wien, he passed away. He was passed away last year. Actually, he passed on October 27, 2023, was the very day the market bottomed. How amazing is that, by the way? No one knew it at the time. I was just reading an old post about Byron Wien. The date said October 27th, 23. I was like, wait a minute, the market bottomed that day. Is that special or what? That's meaningful. If you know Byron Wien, I mean, he would publish his top 10 surprises every year, and I always look forward to reading that. But these, the private equity folks, they're focused on identifying good business models, which is why they are better investors on average in public markets than VCs are, right? VCs are looking for right-tailed outcomes where hopefully get 1 in 20 or 1 in 30 and it returns the fund. And it's more luck than skill. Now, if you're Sequoia, let's say, you have these sourcing advantages and your brand allows you to positive select for good deals. And the companies that you invest in, let's say Cisco, right? Cisco is a Sequoia company, incredible home run. Cisco would then go on an M&A spree and buy up companies that Sequoia was investing in. But Sequoia was investing in those companies because they're talking to the CEO and the M&A team at Cisco around what infrastructure areas that they want to invest in. That's what smart VCs do. They're always talking to the corporate VCs and the M&A teams to figure out what they want and then identify product that suits their appetite. So Cisco and Sequoia had a wonderful dance together for a long time. But that's how VCs make money. If you're very good, like Sequoia, that's an incredible competitive advantage, right? So they have access to these C-suites, and these LPs include these CEOs. They have special insight and access to opportunities and deals and entrepreneurs, although that can come and go. Kleiner Perkins as a brand has faded since the days of John Doerr when he invested in Google, let's say, right? So, it can come and go. Today, it's Blackstone. Blackstone is what Goldman Sachs was 20 years ago, meaning the caliber of the talent and the caliber of the personnel at those private equity firms, and not just Blackstone too, but KKR and Apollo. I mean, that's where talent is. I in my prior life at a startup called Pure IQ, which I built, we did data analytics for a lot of private equity and credit hedge funds, and we'd essentially like a Bloomberg terminal for loan data. And so we had an engagement with Blackstone, and I'll have to be high level here. But they were trying to make a point of view on a decision or on some asset that they had. And a firm like Blackstone, I mean, they own dozens of businesses outright or have a significant share, board seats. They've got all this information, which is what they'll call intellectual capital that they use to make an informed decision. And so we're in this meeting, and they had summoned the CEOs of, say, like a mortgage servicer and some other businesses. And the quality of discussion and analysis and synthesis live on the spot from these disparate parts was just exquisite to watch. And it's the caliber of the people. I mean, it's just a different cut. So that is, private equity is a smart money today. Right? I mean, private equity is not disintermediating the banks they launched a private credit business now. All these guys, the private credit business is bigger than the private equity business. The banks are pulling back. They filled in the lending gap. When I was at Bank of America Merrill, it's all public knowledge. We sold a business to Apollo because Apollo could make loans when the regulator said, hey, Bank of America, you can't make those loans anymore. So, we pulled back. We as a bank pulled back. By the way, it's been a lot more fun since I left Bank of America Merrill Lynch since then, by the way. Merrill was a lot of fun, but these big enterprise institutions it's like working in the Department of Defense or something. They're massive. So some other headlines that popped. Speaking of banks, so Michael Barr leaving the head of supervision. Hooray for banks. That's good news for innovation. That's good news. We'll see what happens next. But I think if we look at the team that Trump has appointed on the Treasury side and with Scott Bessent, and then even the assistant secretary, I mean, they're all very impressive, very capable people. To a name, on the economic team. So that's encouraging. Trudeau's resigning. Now, this is a broader theme, right? I mean, look at around the world, there is loss of trust in institutions, especially government and centralized authority. So you're seeing that play out in Canada. So we're not going to have Trudeau as our 51st governor. That's not going to happen, folks. So we'll see. Okay, we talked about privatizing Fannie and Freddie earlier. This is a good example, right? Where's the attention focused? Do you really want to focus your attention here when everyone's talking about it? I would say no. let's see. So, but yeah, I think some of the things to look forward to, you're gonna get more M&A like this deal that was scuttled. I think that kind of deal would happen in a new administration. So what's going to happen next year, well, this year, is you're going to have the renaissance of merger Monday. So you wake up, you look at the Wall Street Journal, and some merger was announced, and stock prices go up. That's more of the climate we're going to get into next year. You're going to have more M&A activity, and you're going to see firms that are indexed to capital markets do well. They're already doing well, by the way. They're already doing well. They've run up quite a bit. So I think you're going to see more of that happen next year. I think the banks are going to do really well next year too, because they can do M&A, right? The regional banks want to bulk up. They want to get bigger. The community banks, they are concerned about their longevity when they see larger rivals with more technology competing for their customer. They don't mind getting acquired. So I think that's an interesting idea to stay focused on. What else? I think we covered a lot of ground there. Hopefully that was helpful. Stay tuned for this Thursday. We're talking to Michael Prek. And I think next week we'll get a buddy of mine who's a banker at PJT. They're the investment bank that spun out of Blackstone. And he covers all things fintech. So that'd be fun to have him on and get his perspective on what's happening out there. So yeah, I think Friday non-farm payrolls, I think they'll do well, but I think next month's may be even better because obviously this Friday non-farm payroll will cover December, but most businesses are going to start hiring and making those decisions now because the new year has started. So you'll see those results in February's non-farm payroll report, which will be the first Friday of the month. I think the banks will do well. So we have good exposure in that category. I think quite a few banks will do well too. All right. Have a good one, folks. Be well now. Take care. Make it a great week.